Well, it's not just oil investors are focused on, as vague messaging from the Federal Reserve gives investors hope of a slower normalization of policy. I'm joined now by Craig Erlam, a senior market analyst at Oanda, with me now from London. And Craig, the Fed appeased both the hawks and the doves in its statement on Wednesday. What did you make of the Fed's language?
Well, I don't think that was unintentional. I think the Fed wants to maintain its stance, really, that the tightening process has begun, that they intend to raise rates by 3 or 4 times this year, as they've alluded to previously. But they want to allow the markets, they want to allow themselves some space, I guess, to change tact in case these global conditions do deteriorate further. They've mentioned the global, the financial and economic conditions which have hampered the markets at the start of the year. So by noting this, it means that further down the road, say they get to June and they've still not raised rates again, they can turn around and say, well, we were monitoring these conditions and they deteriorated further than we had thought in December. So I think they did appeal to both the doves and the hawks, but I think the important message in all of this was they haven't been deterred quite yet. So
is a March rate hike off the table then?
I think so, but to be honest, when they raised rates in December, I didn't really buy into this whole 4 rate hikes next year, one in March, June, August and December again. I thought that it was a little bit too bullish, really, given that we've got this divergence in monetary policies of these central banks. Other central banks easing, in effect, effectively kind of tightens conditions already for the US. So I thought by that fact alone, I thought that the tightening cycle would be a little bit slower. I knew that it was going to be a tough year for the global economy, and I still believe so. I think 2 rate hikes this year is as far as the Fed is going to go, and I think getting close to that 1% should be a suitable target for it. So I think March at this moment is off the table. I think we're looking more towards May or June, really, for that next rate hike.
So 2 rate hikes, not 4?
Absolutely, yes.
All right, I want to also talk about 2 factors, of course, that have been driving markets crazy over the past month, China and oil. First, let's get to China. What do you make of the injection of 340 billion yuan that Chinese officials added to its markets? Of course, China's stocks falling 2.4% today.
Yeah, I think it's not unexpected, really. The Chinese officials have made it perfectly clear until now that they are willing to do, and I hate to paraphrase Mario Draghi, but they've effectively made it clear that they're willing to do whatever it takes to stabilise Chinese markets, and during this liberalisation process, ensure that the markets remain stable and remain trustworthy, so that they don't deter investors. And investors are going to be extremely important. A confident investor, that should be, is going to be extremely important to the Chinese markets over the next 12 months. We've seen these periods of instability. We saw it back in August. We've seen it again at the start of this year. And what the Chinese authorities are effectively saying here is, we are still here, we are monitoring the situation, and there's no need to be worried.
All right, also oil rallying to almost $34 a barrel. Very quickly, do you think it's safe to say that 30 was the bottom?
No, I think the bottom's going to be more like the low 20s. I think we're seeing a temporary correction at this moment in time, maybe back towards the high 30s, but I do think further downside to come is certainly on the table.
All right, Craig Erlam from Oanda in London. Craig, thanks so much for your time. I'm Scott Gamm, and you're watching The Street.